Good golly, Miss Molly. That's right, folks. What you're seeing on your screen is absolutely a true story. Can you believe this? A 25% decline right here for Netflix stock. You got it right, folks. We're talking about Netflix earnings today. Obviously worth mentioning, a late night bout, but we're going to have a great time talking about Netflix earnings and what in the world you need to do with this stock after a 25% decline. So let's just put this into perspective as is. I think it's very much worth mentioning that Netflix has already been in a massive drop. We're talking about from its highs in 2021, November of last year, we've seen a 50% decline already. And that is prior to today's additional 25% decline on top of that. So we're talking about close to, this is crazy, close to 75%. Close to 75% of the value of this stock has just been lost in a matter of, well, let's just be clear, less than 6 months. You look at the 6 months, garbage. But really, in the span of 5 months, this stock has shed about 75% of its value. Over 70% of its value is crazy in a 6-month period. Now, we still have to preface the fact that over the past 5 years, this stock is still up pretty decently, right? Now, not so much if you take out this $89. We'll see where it opens at tomorrow. Obviously, that depends too, but I think it'll open pretty close to this down 20%. This still is a stock that has gained over $100 a share in the past 5 years, which is pretty significant, right? It's not going to be a triple-digit gain, though, which is kind of crazy to think about over a 5-year period. Netflix is not a triple-digit winner. Kind of crazy, right? And obviously, this is a massive winner in the lifetime of the stock, and no one can say without a doubt. You look, let's go to 2014 even. Since then, still showing 440% gains. Obviously, not after this dip, but this has still been one of the better stocks to own, regardless of this massive dip, which is crazy to think. So we got to put it all into perspective, folks. But let's get into these earnings and see why it fell. Look, if you're like me, you already know why this fell. It's subscribers. This has been a massive concern with Netflix for a while now, and that's why you've really seen over the last year, you've seen a lot of these concerns. Any dips you see are really concerns with subscribers. Now, let's just be clear. I peaked ahead of time, and I'm quite disappointed with these earnings. First off, we'll talk about a GAAP EPS line of $30.53, beats by 62 cents. I do like that quite a bit. We're talking about a lot of content that they've spent money on. To still post a GAAP EPS beat is something I'm actually pretty proud of for them. Kind of shocking given the difficulty of hitting these lines when it comes to EPS with all the spending that has to go into these productions, right? These new movies and shows that get put on as originals cost a lot of money, and you're seeing the cost really way down on a company like Disney. Now the revenue line, we're getting into disappointing territory. $7.87 billion. It is growth of 9.9% year over year, but they missed. So we're talking about a company now that was trading at a very high multiple prior, that's now not even showing double-digit growth year over year. That's concerning, right? Now this company is going to be getting in very interesting value territory, though, so keep it in perspective. But here is why the stock fell the way it did. Oh my gosh. Global streaming net ads. Oh, sorry, not ads at all. They lost 200,000 subscribers this quarter versus the estimate, which is a weak 2.5. I thought they'd hit it. I gotta be clear with you, folks. I'm shocked to see a loss of subscribers, and they had me believing in them. Netflix had me believing in them. But I told you a long time ago, last year, stay out of the stock. I did. I told you, 2021, I told you to stay out of the stock, and I hope you listened, folks, because I was right. There's a lot of negativity coming this way, and it keeps getting worse. Global streaming paid memberships at 221.64 compared to a 224.34 guidance. Here's where it gets even worse. Next quarter, they're guiding a revenue Not good revenue line, 8.05 billion versus an 8.22 consensus and an EPS of $3 versus $3.04. So they missed the consensus on the guidance, but also they're expecting to lose 2 million losses of subscriptions. 2 million subscription losses expected in this quarter. That's crazy, right? They're straight out telling you, look, we're declining. That is crazy. Now, they will preface here that the suspension of the Russian service resulted in a negative 700,000 impact, but still with that, this is a company that only posted a 500,000 compared to a 2.5 million. They missed by 2 million, so that wouldn't have helped. That 700,000 would not have helped this case, unfortunately, because this guidance is horrific. It's horrific for the company, unfortunately. The subscriber line's still massive, but to see 2 million loss it's terrible, folks. That is why you're seeing a massive dip in the stock. So let's just be clear with one another. We're going to get into the shareholder letter and see some of the good things on there, and kind of talk about what's to come with the stock. First, I will mention this is now a company that is after shedding this market cap line here, right? You have to consider that this is a company trading at we'll preface it, trading in a market cap here now of right around, let's say, $115 billion of market cap. Now, the company still only brings in a year, will bring in, I guess, right around $40 million this year. 40 billion, I should say. So we're still talking about around 3 times that value. Now, it's not crazy valuation, but we have to consider the stock is kind of not enticing when they're not showing double-digit growth. That's kind of what gets people excited anymore for higher multiples, higher price to sales than 2. You kind of need some double-digit growth, it feels like, anymore. So, terrible time. So let's get into the shareholder letter, folks. So here they straight up tell you our revenue growth has slowed considerably as our results and forecasts below show. Streaming is winning over linear, as they said. And Netflix titles are very popular, which they are. If you look at the Nielsen ratings, Netflix titles are continuing to perform really well, but that's not causing people to add. They're just watching, which is good for them. Here they specifically call out the big boost that they saw due to lockdowns is now obscuring the picture, or it has obscured the picture, because they felt like the business was a lot stronger than it was, which is understandable. Everyone was locked in their house, and people bought these subscriptions because they had nothing else to do. Now you've noticed that overall the the average savings rate of the American household is back to pre-pandemic levels. People don't have the extra discretionary income that they did due to the stimulus checks. And with that, people are going to be looking through their subscriptions, what they're paying for, and seeing what they can eliminate. And unfortunately, with Netflix rising prices, there's a chance that a lot of people might have seen this as this one might be the one to go. There's so many streaming services they're paying for right now. Which ones are they going to have to get rid of? Netflix might have gotten the axe, and it might still continue to get the axe in the future because of that. So let's keep that into consideration here. You can see the revenue growth slowing. Again, we talked about 24% when you looked at Q1 of last year. Now slowing steadily all the way down to 9.8% when you look at Q1 of this year. And the forecast for next quarter is another decline from there, 9.7% only. Crazy stuff. It's really crazy. So you see the same with paid global streaming ads. Obviously, one thing I like to look at. The net income line, not great. I mean, there's not real consistency with the net income line, as you can see. Can't really highlight it, unfortunately, but the net income line, not consistent. Still, I'm okay with them keeping it around this level. It just goes up and down so much, it's hard to tell. But look at the global streaming paid memberships. They are continuing to grow, technically year over year. And even next quarter, they're expecting it'll be a 5% growth over the year prior. But you can see how the growth rates have slowed significantly. Was double digit in Q1 of last year. Now is sitting next quarter expected a 5% growth. And after that, we don't know. But I would guess it's not going to get better. But, I don't think they're going to be hemorrhaging subscribers. But I think they may have reached their limit for the time being. There's a chance on that one. There is a chance. Yeah, I think that's worth mentioning there. Growth outlook, obviously, this is an important topic to look at if you're a shareholder here. If you look overall in the market share, compared to last year, they have gained market share, right? They're sitting at 6.4% of the market compared to 6% of the year prior. YouTube shrank a little bit. Hulu's still holding in there. Prime Video gained a little bit. Disney Plus gained. And obviously total streaming here hogging up 28.6% of total US TV time. And Netflix is really the biggest company in there right now, at the moment. I should say, at the moment. Obviously, you see companies like Disney Plus getting in there. But again, as I mentioned, the Nielsen ratings look really good for this company. A lot of people are watching their shows, but that isn't necessarily contributing to ads in subscribers, unfortunately. A lot of people are watching the shows, and as they specifically mentioned themselves, they believe that 100 million households are sharing their Netflix sign-ins with other households. So the issue comes with them limiting that now. A lot less watch time, unfortunately. I mean, that's just being 100% clear. You have to understand that if you're a shareholder, you're going to have a lot less watch time as they start to crack down on that, and a lot of people might cut the cord because of it, because they can't share it. Their hope, obviously, is to get those people to add on to the subscription service and start paying for it. But if they weren't before, they were getting it for free, I don't think the majority of them will be adding. Let's just be honest with each other. So, I think you'll lose a little more than you gain, unfortunately. So, and they mentioned it here. Here it is. The 100 plus million households using another household's account is a big opportunity, they say, for them. Sharing likely will help fuel growth by getting more people using and enjoying the service. They'll say that, and obviously now they're going to say now they want to capture those people as their own individual subscribers. So now they're getting rid of that. Yeah, so that's a thing, and they're really working now on monetization in other aspects as well. Seeing as they potentially have reached a cap, this is a company now that's talking about potentially adding a different subscription model in there that includes advertisements. And a lot of these companies do that for a reason. You see Disney Plus do it. You see all these companies add it because it's a way to get a lot of money back. Let me tell you, with ad rates the way they are, they can earn a lot more per user via ads than having the premium service that's ad-free. So definitely will boost the average revenue per user if they do that. And it's a good way to boost the overall revenue when you add that opportunity in there. So that's one thing to look at with them. Yeah, nothing crazy as far as that's concerned. See if we can get some other goodies. This one's a nice one. We like a regional breakdown. What can we see in the regional breakdown? Well, United States and Canada sitting just about 200,000 over where they were last year, so slight growth there. Net loss of 640,000 this quarter in the United States and Canada. Pretty rough. Average revenue per user did grow quite a bit though, so we'll take that. EMEA saw a 300,000 user decline. Latin America down 350, but the Asia Pacific and China is posting a 1 million subscription ad. So that's the only segment that actually showed positive growth there, concern, and the average revenue per user decline there. So what can I say except you're welcome. 5%. 5% decline. What are you talking about? What's happening right now? Average revenue per user, yeah, down 5%. So that's a thing. That's a thing. Do you got any other maybe a balance sheet I can look at? Oh, baby, you know I love a balance sheet. You know it. Total assets. Oh yeah, that's right. This is only it's only a 3-month comparison, folks. We're gonna have to make it. We're gonna have to make it make do. Okay. Total current assets on this company sitting at $8 billion, $8.1 billion. That compared to just under $8.1 billion of 3 months ago. Not much movement here at all in the balance sheet. So nothing crazy. Total assets in general at $45.3 billion compared to $44.5 of 3 months ago. So definitely some growth there. Sorry, I hear noises. There is some growth there. Pretty cool. I mean, not by much, but a little bit there. And you can see it in this content assets line and the other non-current assets line as well. Current liabilities sitting at $7.7 billion compared to $8.4. Good to see that they declined that and obviously kept the assets on the rise. It's good to see that. And total liabilities in general at 27.7 compared to 28.7. So they shrank the total liability line by about $1 billion, and they were able to grow their assets by about $1 billion. So that's actually good for shareholders. And the equity at 17.5 compared to 15.8. That's what I got for you. Have a great time. Look, I'm staying on Netflix stock for now. Staying out of it. Have a good one.